Welcome to Stocks in Translation, our essential conversation cutting through the market mayhem, the noisy numbers, and the hyperbole to give you the information you need for your portfolio. Now, today I'm joined by Brooke DiPalma, thank you, and Brian Levitt as well. He is the Invesco Global Market Strategist. Welcome, guys.
Thank
on
you.
the docket today, we're going to be talking about two of the biggest drivers of stock prices. That would be earnings and the Fed, and we are in the thick of it on both fronts. We got a Fed meeting this week, and this is the biggest week of S&P 500 earnings, which leads us to our phrase of the day, reinvestment risk. It's a wonky phrase that hails from the bond market. Why you must understand it, keep getting those juicy savings account rates, and they're not going to be 6% forever. And this episode brought to you by the number 99. That is the day count until we get to Election Day, November 5th. Why the Trump versus Biden race is not the biggest concern for investors. So Brian, before we really get into the meat of the conversation, I just want to get your big picture overview of where we are in the markets. We just had a painful rotation, but as I said, it's all about earnings and the Fed this week.
It is all about earnings and the Fed going forward. And we had a very concentrated market for a lot of this year, much to the dismay of many investors. And you saw a little bit of a rotation over the last couple of weeks amid expectations of lower interest rates and a normalized yield curve. What we're dealing with now, we have to be realistic. The economy is slowing. The Federal Reserve rate cuts are priced now. So we've had the three that are likely coming priced. And so you may have a shift back towards a little bit more of a higher quality mega cap portfolio than what you've seen over the last a couple of weeks with this great excitement around the great rotation.
Well, I want to get to our phrase of the day here because it kind of ties into what the Fed is doing, and that is reinvestment risk. And I'll tie it all together, but first, let me define it. Reinvestment risk is a possibility that the income from an investment, like bond interest, will have to be reinvested at a lower rate than the original investment. So you don't get those high rates. This means you might earn less on new investments if rates go down. And this is based on a very simple premise, Brian, that rates are going down, but a lot of people aren't prepared for this because, savings rates they adjust with the flow, with the short-term benchmark rates. So what should people be doing?
Well, people should be looking beyond short rates. If you like a 5 or 6% yield for 30 days, you'll probably love it for 10 years. And so too many people look at it and say, well, I can get this at a risk-free rate, essentially a risk-free rate. Why wouldn't I just do that? And to your point, Jared, exactly, it's the reinvestment risk. And I'll give you an anecdote from my own family. My father talks about it all the time. In the early 1980s, when money market CD rates were 18%, 30-year treasuries.
18.
Yeah, 30-year
Imagine that.
Yes.
Right? And 30-year treasuries were 16%, and he loved 18. Right? So he decided not to go out into 30-year treasuries, and over time, that 18%, had reinvested all the way down to nothing by the global financial crisis. So if he had just locked it in, maybe I wouldn't have grown up in such modest means.
Well, we can get there in a second, but Brooke, you had a question.
Would love to understand how are investors, how do they make the decision of where to go best in this sort of environment? Of course, so I cover retail, restaurants, and consumers are really slowing down there. We've seen some winners like a Chipotle, McDonald's not doing as well. But when you think about where investors should be looking right now, is a CD still a safe place?
Well, the CD is a safe place except for the reinvestment risk.
Yeah.
And so the point is, if those rates go lower, so the risk to the equity market to some extent is a slowdown in economic activity. If economic activity slows, the Federal Reserve will jump in quicker and bring rates down faster. We've seen that in different cycles in our lives. And so investors that aren't taking advantage of the greater than 4% yields right now that
Say
they can get, in corporate bonds, even U.S. Treasuries, municipal bonds, they may find that as the economy slows, the entire yield curve will shift down. Now, short rates will go down faster, but those 4 and 5% may come down as well. So if you have an income portfolio, it behooves you to think, again, beyond just a handful of days and what the next few years may look like. I'll tell you, in 2019, people were begging me for 4%. And at the time, I used to have to say you had to buy high-yield bonds or you had to lend money to the Russian government. Which one do you want to do? And now you can get it in U.S. Treasuries.
It's amazing because nobody really saw higher interest rates on the horizon. Then you get a pandemic and things can change very, very, very rapidly. We were just talking about how to protect your cash holdings and lock in a rate. What about the investment side? If you're expecting shorter rates by the Federal Reserve, that implies that we're at a certain stage in the business cycle when the Fed is cutting. traditionally certain sectors outperform others. You get into any of that, or is it just press a button and see what happens?
Well, it depends on the macro environment.
Yeah.
Okay, so typically what happens, in a lot of instances, the Federal Reserve is lowering interest rates when a recession has already started. A recession
So the
is...
writing's on the wall, and that's important to differentiate. Because
Yeah.
if the recession is already here, they're cutting 100 basis points.
And that's when you start to get the early cyclicals, you start to get the small cap, the value, right? That's a very different environment than if the Fed sticks a proverbial soft landing. So if we're not already in a recession,
No,
right?
and the soft landing is still the base case.
And I do want to point this out today. A firm CFO told Yahoo Finance, Brad Smith, he said, as long as consumers feel like we're in a recession, it actually doesn't matter if we are. And I thought that speaks volumes to just consumers' perception of the overall macro environment that we're seeing right now.
Yeah, but usually in a recession, or when you're tiptoeing towards a recession, you see a lot of leverage in the economy. You see a lot of excess. And by excess, I mean businesses have too much inventory. There's too many homes for sale. We're in the exact opposite position. There's not enough business, or at least there wasn't enough business inventory. There's not enough homes. Anyone looking for, there's not enough homes on the
And
market.
prices, forget about it. They're insane right now. They still
it's-
are.
Yeah, so it's not a leverage excess story. Corporate bond spreads, so the borrowing cost of businesses have not gone up. So it's not a recession environment, but rather it's a slowdown, and things could get worse if the Federal Reserve stays at 5.25 for too long. So if they start to bring down rates and navigate the soft landing, then leadership looks different than if you're already in a recession. And think about 96, 97, like the last time we had
The real soft
landing, it was still mega cap, tech type names. So we've had a little bit of a rotation here, but unless you're going to get a really reinvigorated economy, you may still see larger cap and higher quality outperform, at least in the near term.
To Brooke's point, I think this kind of gets back to Wall Street versus Main Street. And I'm with you, Brian, that I look at the economic data every day. We're not in a recession now, and I don't see that we're on the immediate precipice of one. But there's a perception out there, and I'm wondering how much this perception in investing matters when you have a significant amount of the percentage of the population who think, they look around and they say, okay, we're in recession, things are bad for me. Does that factor into your investment analysis?
Well, people report their own finances better than they report the situation for all consumers.
True.
And, it's like people like their own congressperson rather than they like Congress, right? You look at what's going on, around you, I'm okay, but it's the rest of the country that has
they're not
problems.
okay.
Yeah, they're not doing well. And we have to remember we still have a historically low unemployment rate. Now, you may start to see some cracks in the job market here, but there are plenty of jobs open. Most Americans that want to be employed are employed. You've seen in a lot of cases wages keep up with the price increases. I think what the problem is, the inflation shock has now reset prices. And so every time you go out, you don't feel as wealthy as you once did, even if your wages kept up. And the aggregate data says for a lot of people, their wages did keep up, but they tend to describe it as, well, I earned that, right? And so these prices shouldn't have
But these
done
prices, they're just taking more of my money away now.
They are taking it. But remember, if you are paying it, that's somebody's profit. And somebody's profit becomes somebody's wage, and somebody's wage becomes somebody else's profit. So if you can do that in a virtuous way, which the Federal Reserve is trying to accomplish, then it's, it does not have to be a disaster for the economy. But let's be clear, the Fed wanted things to slow. Things are slowing.
Well, that was a stated objective. It had to.
We don't want 9% inflation rate. And so inflation's in the comfort zone. And now the economy's slowing, just what they wanted.
Yeah, and I do want to hit quickly. This week, we have a slew of tech earnings coming out. And when you think about how Americans, how investors should perceive these tech earnings and, translate into their own portfolio, how are you putting it all together? Where should investors really be looking, and how much noise will this create ultimately in their decision making?
Well, there's a lot of these companies that are a big part of the broad indices that people own, so they should be focused on these companies. Now, some, like a Tesla, may be a little bit more idiosyncratic. Those who are competing for supremacy in the artificial intelligence space may have more of a true impact on their business models and the rest of the financial market. So these are the companies, yes, they've been bid up quite a bit, but they've also delivered on earnings. And you've seen these companies where they've had significant gains in the last couple of years, but their market valuations have not increased a lot because the numerator being price and the denominator being earnings have both gone up, and they've gone up somewhat in lockstep. So we want to continue to see if this trade continues to work, and ultimately where this AI idea goes, everyone's so focused on who has the software, who has the service, who has the picks and shovels that can bring this to market. The next stage is the markets start focusing on who it benefits beyond that. The financial sector, the healthcare sector, the energy sector. So there's a lot of downstream beneficiaries of artificial intelligence and advanced technologies that I think the market isn't even focusing on yet.
Where do you see that, or when do you see that getting priced in? Because AI, in my view, is something that develops throughout into the end of the decade. But so what can we expect in the next year or two? Because the price can get away from hype in both directions.
Yeah, the price can get away from hype. Again, the good news, a lot of these companies have been delivering. What you want to see is, does artificial intelligence take the country to a new level of growth? And, in essence, there's two components of economic activity. There's labor force growth, and there's how productive the labor force is. And if you look globally, there's not a lot of labor force growth. Right, most countries around the world, at least most developed countries. Yeah, we all have less children than we did in the past. And so what you need is the productivity gains. And for people waiting for cyclicals or value, things like energy, financials, different parts of the market to rise to the fore, you likely need a new higher sustainable level of growth. And so that's what we're going to be watching. When I say in the near term, it may continue to be the larger cap, growthier names that outperform, is because we're slowing. Right? The next step needs to be Fed policy plus productivity enhancements taking us to a new level of growth, which will reinvigorate the other parts of the market.
All right, we need to take a short break here. Coming up, we're going to be talking election investing and not getting too wrapped up in it. Plus, the ghost of John Bogle visits us in an all-new Who Wore It Better? All right, we are back, and it's time for our sponsor of the day, which is the number 99. Happens to be the number of days before Tuesday, November 5th. And guess what? That's election day. And now let's talk about how to approach this as an investor. And Brian, we were just briefly talking offline about how investors got both the Trump presidency wrong and the Biden presidency wrong. You look at what happened with energy. Traditional energy did poorly under Trump, did very well under Biden. Clean air did very well under Trump and did very poorly under Biden.
The presumed trades that investors thought.
So this was what people were thinking when we walked in 4 and 8 years ago, and it turned out to be completely different. How should investors be thinking about this election?
Yeah, they probably shouldn't be putting too much focus on. I think a lot of people didn't have traditional energy underperforming under Trump on their bingo card. So what do you do about this? I think it's important, even before, Jared, we get into sector or industry, is just think about the broad market, because I've been doing this now 25 years, and every 4 years someone tells me that there's a candidate coming along who's going to be terrible for the markets, and that's almost never been the case.
Well, Bernie Sanders has never been president.
I mean, you can go back to Eisenhower. Every president's had a positive return over their term, except W. Bush and Nixon, because their terms ended in recession. So that's just bad timing. Now, if you think about even this Trump-Biden or now Kamala Harris election, just think about what's gone on over the last 8 years. In 2016, we were told, right, by politicians or pundits, Trump wouldn't be good for the market, maybe because of him being an outsider or the lack of clarity around what he wanted to do. Markets were up, even with a pandemic, over 60% from the day Trump was elected in November 16. We heard something similar in November 2020. In fact, Trump himself said your 401k will go to zero if Biden wins. And the market, since Biden was elected in 2020, is up 60-something%. So they both had very similar returns. Not only that, they both came out strong out of the gate, only to have bad years too. Why did they have bad years too? Because the Federal Reserve was raising interest rates in 2018 and 2022. So stop telling me that the president matters more than the Federal Reserve. When the Levitt family goes to Washington, D.C.,
That could be a movie, by the way.
yeah, I say, we're not going to the White House. We're not going to the Capitol first. Let me show you where the real power is, and we go to the Federal
Bureau of
Reserve.
Printing and Great.
But, as investors think about their portfolios and they think ahead of the election, where should they really be focusing leading up to the election and after? And I always think of, say, my mom who's about to retire. She's at that age. How do you potentially prepare for what could be before and right after this election?
Well, you've never actually seen volatility increase before elections unless you're going into a recession. So you can look back at all of these elections, and the only time you saw volatility spike in October and early November was 2008, which had absolutely
After Lehman Brothers.
Yeah, it had absolutely nothing to do with
Outside
those
factor.
elections. And so I've heard all year the second half may be volatile, you may have a drawdown. Well, does anybody actually run the numbers? Because that's not the case. My view on all of this, I was taught when you do market strategy, you first assess where you are in a business cycle. You then assess the next most likely direction of the economy, which I said is slowing. You then assess what the Federal Reserve is going to do, which is easing. And as a result of that, contemplate what market leadership should be. Nobody has ever once said to me, also include who the President of the United States is going to be. Because for the wisdom of the Founding Fathers, we don't have autocracy. We don't have monarchs. We have a system of checks and balances. Right? For 100 years, the consumer's been 60, 70% of the economy. The private sector's been 20% of the economy. It doesn't change no matter who's president. So if the winner of the election is not going to meaningfully change the direction of the economy or what the Federal Reserve is going to do, then we largely just view it as, what we all personally want politically, from a societal perspective, but not the implications for the markets. Remember, Barack Obama and Ronald Reagan both had 200% returns over their 8 years.
And not only that, the market was down, I believe, for Reagan. There's this thing where you look at the stock market, how it's performing 3 months before the election, and that tells you whether the incumbent wins or not. But that kind of bucked tradition with Reagan. Just suffice to say, things don't always happen the way we think they will.
Yeah.
We got to get to today's Who Wore It Better? We're going to tackle a perennial question for investors: to stock pick or not to stock pick. And we're sending active investing head to head with passive investing. The key to our comparison is our question: which style, active or passive, is more likely to succeed in this environment? Do you think it's better for people picking stocks, or is it better for those who are dollar cost averaging their 401ks with plain vanilla S&P 500 funds? Most importantly, we just want to know, how are you thinking about this when you approach your own investments or just talk to clients?
Yeah, there's different parts of the market where active investors tend to benefit, or perhaps there aren't as good indices that you would want to be exposed for, maybe places like the emerging markets or international markets, or even some of the more value-oriented parts of the market. You may want to look to an active manager in the largest 500 companies in the United States. It's been difficult to outperform. Now, you can do it perhaps with rules-based investing, different weighting methodologies, but it's been hard for the managers to outperform. But remember, we've been in a very slow growth world. And in a very slow growth world, the gains accrue to a handful of businesses. So that's why, even coming out of the global financial crisis, slow growth, anytime it looked like things would reaccelerate, during the 2010s, we kind of stubbed our toe with European debt crises and trade wars and pandemics. So we haven't seen an environment where the U.S. has moved to a new level of growth, a new, exciting, sustainable level of growth. So in that environment, which we haven't seen in a while, active managers can rise to the fore. And so when we talk about the market broadening out, as the Fed normalizes the yield curve over the next year plus, that should be a better environment for active managers than what we've been in, which is slow growth only accruing to a handful of names.
Death to ZERP.
I would love to understand too, given that, so often I'm discussing different companies and we sort of see this, you say the consumer is slowing down, but we're seeing different companies do differently or outperform differently. How does an investor take into consideration that, individual companies investing in, say, a Chipotle or a McDonald's based on how they're doing versus say, hey, maybe I should go into a mutual fund or an ETF, et cetera?
Well, the nice thing, what mutual funds have done, the democratization of investing, allowing people to get access to a broad array of businesses so they're not making the individual stock selections by themselves. And, if you look at broad indices in the United States, whether of the value variety, the core, the growth, small, mid, or large, they've done a very good job over time compounding wealth and helping people get to their investment goals, right? There's really no greater wealth compounder than I can think of than the U.S. stock market, or at least over the last century. So, investors that don't have the time to research businesses or don't believe they have necessarily the acumen to do it, then mutual funds, exchange-traded funds, separately managed accounts have really created that opportunity to have that type of exposure. Now, if you have a particular level of expertise or you feel strongly about that, certain companies, certain consumer businesses, or a daughter could walk into Costco and be like, I love this place, we should own the stock, or McDonald's, or right. If and you want to invest in these things, then by all means do your research, understand the business model, understand the risks, and right size a position that can make sense for you.
Brian, we got a few minutes left. I want to ask you, we always gather notes, and we did ask you about some things here. Something really interesting. You said it was not my intention to be in this industry or in this line of work. So I got to ask
Wait a second, what?
What industry do you think you were intended?
Well, I think I went to college thinking I was going to be a history professor at a university, and then after that, most of my internships were either with sports leagues or with sports teams. So I figured I would be doing something in that line of work or something in entertainment. And
well, we're here.
Yeah, that's the irony of it. When I was 22 and all my friends were moving to New York City, I needed a job that would actually pay me something so I could rent something terrible in the city. And
shoebox.
Finance.
And in 1998, that was the financial services sector. But the advice that I give to people is no matter where you land, create the job that you want, or at least try and fill a void that may exist. And so, in my job, I study history. In my job, I write about history, and I,
you're entertaining.
And I get to do, things that hopefully are entertaining. So, it's about navigating, the opportunities that you have and trying to figure out how you carve a role that, really speaks to the things that you want to be doing.
It says that you visit the sites where significant 20th century events took place. Just curious, any particularly memorable visits?
Yeah, very much so. I was in Munich a couple of summers ago doing a Third Reich tour, which included a stop in Dachau, which included a stop in Nuremberg to the Nazi party grounds, which was very interesting. Last spring, I was in Israel, very timely now, up in the Golan Heights, learning about the '67 war. This fall, I am going to Poland.
Amazing.
So we will be in Warsaw, learning about the start of World War II, and then some of the the ghettoization that took place there, and the uprisings, and so and the mass deportation. So it's I don't know what to make of it. That some people like to lie on beaches. I like to visit places where really historical and interesting things have happened.
Now's the time to see them, absolutely.
Yeah, I don't know how to exactly describe it, but it's of significant interest to me.
And definitely shapes you as a person.
Absolutely.
I'm sure.
All right, we have to leave it there. Believe it or not, 24 minutes has passed since we began. And as we wind things down, just want to thank you again, Brian, for stopping by here along with Brooke. Don't touch that dial. Leave it tuned here at Yahoo Finance.